The three-candle method, a precise simplification of Wyckoff theory and the refutation of ICT myths. In recent years, the language of technical analysis has become crowded with patterns, concepts, and models that often confuse traders more than they clarify price behavior. One of the clearest examples is the popularity of ICT theory, which borrows partially from Wyckoff's ideas, but translates them incorrectly, mixing cause and effect. I chose to strip these concepts down to their core and rebuild them into a simple yet precise framework, the three-candle method. The core understanding of price movement. Price doesn't move because of smart zones or hidden blocks. It moves as a result of transitions between balance, imbalance, and rebalancing. Every market movement consists of accumulation, expansion, and redistribution. Most traders only see the result, a large candle, a block, a breakout, while ignoring the process that created it. The problem with ICT and the misuse of supply-demand blocks. ICT teaches traders to identify areas where institutional buying supposedly occurred. In reality, most of these zones represent a temporary imbalance created to collect liquidity from the opposite side, not institutional intent. This misunderstanding causes traders to anchor their decisions to old, meaningless blocks rather than to the underlying mechanism driving price. The three-candle method. My approach is based on a simple observation. Every market process, whether accumulation or distribution, can be identified through just three candles. The pressure candle. This candle expresses intent. It usually appears with high volume, a wide range, and a strong close relative to its range. It marks the transition from balance to imbalance. The reaction candle. Equally important, this candle reveals whether the market wants to continue or resist the prior move. A weak reaction to a strong pressure candle suggests continuation. A sharp opposite reaction signals the start of a structural shift. The confirmation candle. This is the decision point. If the third candle confirms the direction of the first, the market enters the expansion phase. If it rejects again, a new accumulation or redistribution structure is forming. These three candles represent, visually and precisely, what Wyckoff described through long narratives of phases, tests, and springs. The Wyckoff parallel. Wyckoff described the market as a continuous process of accumulation, testing, breakout, and verification of strength. If we simplify his phases visually, each one can be reduced to the same three-candle sequence. The pressure candle is equivalent to the PSY, preliminary support to supply. The reaction candle is the test or secondary test. The confirmation candle reveals the true direction. Thus, Wyckoff's intricate storytelling becomes a measurable, repeatable process grounded in visual clarity. The advantage, simplicity without losing depth. While many traders chase institutional zones and smart money footprints, I focus on the simple interaction between three candles. Every market structure, accumulation, redistribution, or reversal, is born from the same micro-sequence. Instead of drawing boxes, I study the balance and reaction between these three candles. The result is a cleaner, time-frame-independent market red. Conclusion. The three-candle method is not another variation of ICT, nor a simplified Wyckoff extension. It is the essence, a precise distillation of the market's balance principle into a visual form that can be read instantly on any chart. Rather than guessing what institutions might be doing, I read the market through direct evidence. The last three candles tell the entire story.